We're going to get started with a fireside chat about the regulatory view of financial stability. I'm very happy and honored to have two gentlemen who have some fantastic insight. To my right is Dick Berner, who is with NYU's Stern School of Business and previously was the first head of the Office of Financial Research, which was established by DoddFrank. And to his right is Mike Piwowar. Mike is with the Milken Institute. He's an executive director there on their Center for Financial Markets. And formerly, as I think everyone knows, was an SEC commissioner and was in the government for an extensive period before that during the eye of the big storm that we've all talked about. So we're going to talk about regulation and the current environment, the potential future environment, where things have been, where they're going. And I'm going to start with an audience question that I'm then going to ask our speakers up here, which is, where do you think we are in the bank regulatory cycle? So starting on the right, A, regulators will continue to gradually ramp up regulation of banks. B, substantial new regulation is unlikely, but tightening will continue. C, bank regulation has peaked, expect modest rollbacks, or bank regulation has clearly peaked, be prepared for substantive rollbacks. So to your Glisser app. Right. Well, at least 5 of you have answered. I'm going to say there's 10 of you that have answered, and 8 of you think that regulation has peaked, expect modest rollbacks. So let's try and sort of put the current regulatory environment in context. Depending on who you talk to, some financial market participants think regulation didn't go far enough. Others think we went way too far. Some are saying we're now easing too much, and that particularly we're easing at the wrong time. And others say, oh, well, we've barely begun to trim the regulation that we've seen come into place over the past 10 years. So I'll start with you, Mike. Where do you feel we are in the regulatory cycle, and will the recent easing momentum that we've seen, particularly in the U.S., continue?
Yeah, so as often the case, right, people view sort of extremes on stuff. The truth is somewhere in the middle, right? I think what we're going to see over the coming 2 years is we're going to see some modest rollbacks, if you will, or what I would say calibrating on some of the regulatory responses in the wake of Dodd-Frank. So if you think about after the financial crisis, Dodd-Frank told the regulators to promulgate 400 new rules and regulations. Of which the SEC, where I was at, was responsible for about 100 of them on an individual or a collective basis. It turns out that the regulators got through most, but not all of them. And like any comprehensive, substantive piece of regulation, there was a lot of provisions in Dodd-Frank that sort of left things to the regulators. And there were a lot of provisions in there that were either overlapping or redundant or caused the regulators to, in order to comply with the law, to put in place a number of regulations that maybe didn't have the benefits that it necessarily viewed in terms of isolation, in terms of that particular provision, because you've already had other provisions that dealt with it. So what the regulators are doing now is taking a step back and saying, look, the financial system is much safer. Comptroller of the currency, Joseph Otting, recently said something like, the capital is like 3 times as much in the banks as we had before the crisis. Liquidity is 30% better. On those measures, the banks are much safer. But then you have a lot of other costs in terms of compliance and regulation. And is there a way to look at some of these regulations in review? Are there ways to think about taking some costs out of the system without sacrificing any of the benefits? So on that front, I think you're going to see continued more sort of rollback on that. Having said that, I mentioned that most but not all of the regulations from Dodd-Frank have been promulgated. So one, for example, Section 956, which is an incentive compensation rule for banks, has not gotten done. And at the end of the last administration, those of us that were holdovers through the Trump administration were happy to not see that get done. Until the new administration came in and they could take a look at it and calibrate a particular rule, and that they're now taking a look at that. So you're going to see some things potentially move forward, other things potentially coming back. I think one thing to note is I don't see Congress getting involved in this very much at all. They've already done S-2155, which was Senator Crapo was able to shepherd that bill through the Senate, get Democratic support, get the House to pass that bill. It provided a number of relief, particularly for small banks, and sort of did some tweaks around the edges. I don't see any appetite on the Hill for them rolling back any of the DoddFrank provisions or adding anything substantive in the absence of some sort of headline event or some sort of other crisis. So right now it's up to the regulators, and I think you're going to see a sort of a combination of the two.
Okay. Dick, similar question. Where do you see that regulatory needle pointing?
Sure.
In terms of too much, not enough?
So first, Kevin, thanks for having me, and it's always a pleasure to sit with Mike on the podium. As traditionally is the case, Mike's to my right. So not surprisingly, I'm going to end up in a somewhat different place, which is good, so we can have a discussion about it. But, we have, obviously, as Mike indicated, and he covered most of the waterfront, when you put together as comprehensive a piece of legislation as was Dodd-Frank, you're going to make some mistakes, you're going to do it in haste, you're going to do some things that need to be changed, and that certainly is the case for Dodd-Frank. And so, the whole environment that Mike has described to make regulation more effective, efficient, and appropriately tailored, I think has been the mantra in Washington. I think that 2155 probably does represent the only congressional initiative we're going to see for a while. I think that you've seen the regulators already implement some of those things, particularly the banking regulators, with the Fed having put out a number of proposals, and there are still some out there. In addition, what you've seen is that the Financial Stability Oversight Council has put out some interpretive guidance proposals related to things like designation under Section 113 of Dodd-Frank, and how those will be used and how those will be implemented. I think generally speaking, the efforts to make things tailored are appropriate, because it's pretty clear that we can't have a one-size-fits-all approach to regulation, given the diversity and heterogeneity, if I can use that big word, in our financial system and in our banks in particular. Having said that, I would say that in certain cases, I think one of the things that's happening, well, I just mentioned two things. One is when we think about regulation, there's microprudential regulation, as we like to term it, which applies to individual institutions. There's also the macro-prudential regulation or system-wide regulation. And on that score, I think one of the things that's happened is that the Financial Stability Oversight Council has begun to walk back a little bit from some of the things that they've done. And I am concerned that they're walking back too far. And we may be not paying enough attention to some of the risks that may be emerging in the financial system. And the second thing is that that's related to that is that for banks in particular, some of the efforts to make things tailored and effective may have also swung back a little bit too far. So, take living wills, for example. Living wills, clearly there's a lot of confusion and a lot of concern about their purpose and the way that they're supposed to be implemented. And we can use some improvement in the way that living wills are both crafted, the way that regulators work with those they regulate to make them more effective. But to reduce the frequency of living wills in some cases to 6 years, to me makes less sense than actually taking a look at the content of the living wills and making them more effective, making them really focus on what are the things that are likely to kill an institution, because that's actually what everybody wants to know. And same thing with stress tests. I think reducing the frequency of stress tests to me makes little sense. I think that instead people should look at the way that the stress tests are really being conducted, and to get better alignment between what regulators do and what firms do in order to assess risk.
Well, it's interesting. I took a peek at some of our bank analysts, and they were nodding their heads. So from a creditor standpoint, a creditor protection standpoint, we think that some of those rollbacks are credit negatives. Doesn't mean it's negative from a business
Yeah,
or an
and-
equity standpoint, but
Oh,
from
that's absolutely right.
from a
And so,
clarity.
I've seen recently that you actually decided to downgrade a couple of institutions based on that. So.
And can I pick
Go
it
ahead,
back?
please, Mike.
So as always, Dick always reminds me of stuff I forgot to talk about. But one of the things, so he mentioned the phrase efficient, effective, and appropriately tailored regulation. That language comes from an executive order from President Trump that he issued early on in the administration, directing the Treasury Secretary to look at changes to financial regulation or legislation consistent with a number of core principles, and that was one of the core principles. And as a result of that, the Treasury put out 4 different reports. The first one was on banking, and then they had one on capital markets, and then the third was asset management insurance, and the last one was on non-bank financial innovation. But if you want a roadmap in terms of what are the potential things that are on the chopping block or on the hit list or things that are going to be tweaked, look at that report. It's the first core principles report put out for Treasury on the banking sector. There's a number of those recommendations in there that are directing the financial regulators to look at very specific items, whether it's the Volcker Rule or living wills or some of the other items that are there. So if people want a roadmap of what's likely going to happen, that's it.
So one thing, Kevin, we're talking at a banking conference, right? And so it's important to talk about banks and bank regulation, but I don't think we can avoid the fact that one of the areas where we haven't paid enough attention to regulation and risk assessment is outside the banking system. And that's because we don't have as good information about it. It's because we're seeing a lot of innovation, and we can probably get to talking about a little bit of fintech and innovation in a moment. But I think that that's an area where we need to pay more and not less attention to the risks that it might be emerging.
In listening to your responses, you guys both mentioned a number of different regulatory entities, agencies. I want to talk for a minute about regulatory cooperation, coordination, or the lack thereof. One of the criticisms pre-crisis and during the crisis was the fact that we had a lot of regulators that had jurisdictional responsibility, but the coordination among those regulators was lacking, to say the least. Either they couldn't or they wouldn't for certain reasons. I'm curious whether you think that there's been a substantial improvement in cooperation among the various regulatory entities, the Fed, the FDIC, the SEC, CFPB, OCC, you name it. And then my second part of that question is, how about between the US and Europe in particular? Do you feel that there are significant conflicts in the regulatory environments, structures between the US and Europe? So first, changes amongst or improvements amongst the US regulators, and secondly, versus Europe.
Yeah, I can go first on that. I think there definitely has been. The Financial Stability Oversight Council is one forum in which there's been obviously a lot more cooperation. But as I mentioned earlier, I think that they have walked back somewhat from looking at some of the issues that they are mandated by statute to take a look at. Nonetheless, I think it is a forum in which people come together and talk and discuss things in which they can collaborate on all these things. The banking regulators, as most people probably know here, have long cooperated with each other, even though they have different mandates, different coverage through the FFIEC and other venues, so that they can, they have long worked together. One of the areas which is important to work together is that everybody should be using the same set of facts. And at the FFIEC level, the banking regulators are sharing data with each other. That's less true between the bank and non-bank or market-based regulators. More of that needs to happen. We filled some of the important data gaps there, and sharing those data in an appropriate way so that the data are not compromised, they are not confidential data, don't fall into the wrong hands. All that needs to be done. So generally speaking, I think there is better cooperation, but there could be more. Between the US and Europe, there's been pretty good cooperation on a couple of fronts, particularly in the derivatives space. And so I think that particularly, I give a lot of credit to the outgoing chair of the CFTC, who's worked very hard, and his predecessors, who worked hard to achieve essentially equivalence. Likewise, at the SEC, there's been substituted compliance. that helps bridge the gap that exists sort of naturally because we have different sets of laws and regulations in different jurisdictions. But what we want to focus on is making sure that the regulations are in an economic and financial sense are essentially equivalent as we can. Naturally, there are going to be conflicts, but I think some of them have been worked out. I think that one of the key areas where we achieved some coherence is on resolution. Back in 2012, the FDIC and the Bank of England worked on a cooperative agreement for resolving large, complex financial institutions on a cross-border basis. That's never been tested. A lot of work's been done, but I think here's an area where more work needs to be and can be done.
Mike?
Yeah, so I agree with Dick on a number of his points. As he mentioned, the bank regulators had always been very good at sort of sharing information with each other. Having been at a markets regulator, not so much cooperation was going on, right? During the financial crisis, I was at the White House and was attending as a +1 what was the precursor of the FSOC, the President's Working Group on Financial Markets. It was sort of an ad hoc group of folks, similar regulators, group of regulators that got together. It was actually created after the 1987 stock market crash. It was sort of an ad hoc way to sort of get things going. And there was a lot of discussion stuff, but not a lot of sort of sharing of data. And in some cases, the data wasn't even available. So one of the things that before DoddFrank was passed was that people don't realize is the over-the-counter derivative market, which was that's where a lot of the counterparty exposures were among the banks. The regulators were actually prohibited by law from even collecting that data. There was zero regulatory transparency on exposures in the, say, the CDS market or any of the over-the-counter derivatives market. One of the good things about that DoddFrank did was created regulatory transparency, requiring of reporting to the CFTC or SEC, depending upon if it's a swap or a security-based swap. And so now that data is available. And the second thing that DoddFrank did was created the OFR, the Office of Financial Research, as a way to collect the data and then share it among the regulators. And Dick should get a lot of credit for this, is working with the regulators to be more forthcoming with the data, having the OFR being the support group for the FSOC so that everybody is sharing the same set of facts. You can argue over policy, and you can argue over other sorts of things, but everybody should have the same data and the same set of facts. Fast forward to when President Trump came in, I was acting chairman and then went to the FSOC meetings. It was a tremendous difference in terms of from the PWG to the FSOC in terms of the sharing of information. And so I'm very happy and positive about sort of things that are going in there. Vis-a-vis Europe, it's getting better. After the financial crisis, Dick mentioned in the derivatives space where there was equivalence. There was a lot of sort of personality fights, political fights, sort of between various people that were involved. That's now sort of subsided. Dick's absolutely right. Chris Giancarlo, the current chairman of the CFTC, should get a lot of credit, and Tim Massett, also his predecessor, in terms of sort of lowering the rhetoric and actually getting to work and working on that. The CFTC, the SEC, we always had very good relationships with folks over in Europe. We had to deal with outside the banking system, something called MiFID. We had to work with those regulators on that. It was, we worked with them. They had some provisions in MiFID that were going to have some knock-on effects in the U.S. What we were able to do is do some no-action relief for our folks to allow them to get MiFID in place, and then for us to figure out what's going to happen, and then 30 months later sort of figure out where you need to go there. But it's everybody kind of wants to get to the same thing. We're not going to always have exactly harmonized rules, but you want sort of substituted compliance. If your rules aren't the same as mine, but your rules are still good, we're gonna think about that as a way to make the system more efficient and more effective at the same time. And then also even within the U.S., right? So with the derivatives legislation, it divided up, and DoddFrank divided up jurisdiction between the SEC and CFTC. CFTC didn't have many other regulations to deal with, so they went forward with all of their regulations and are essentially done. The SEC was behind the curve because we had a bunch of other stuff to get done. And now the SEC and CFTC are actually working to try to harmonize the rules even within the U.S. And so it's constantly a work in progress.
So just if I could follow up just a little bit, I worry that, particularly globally, that fragmentation and focusing only on national as opposed to international interests in a very interconnected world, can undermine some of that collaborative framework. And I think it's really important to think about that, because as we think about the risks that we're going to be facing, particularly some of the non-financial risks, whether it's cybersecurity or climate change or geopolitical or conduct and culture, a lot of those things know no boundaries.
Yep.
And as a consequence, the need for global cooperation and collaboration on these things is really important.
Yep. Agreed. And it's encouraging to hear that at least directionally you both feel like things are moving in the right way.
Or have.
Yeah. Hopefully they'll continue. You just mentioned conduct risk, which is a subject that is near and dear to my heart, not because of my personal conduct, but.
You're beyond reproach.
Yeah, no comment. I mentioned in my opening comments that Fitch has published these ESG relevance scores, which indicate the impact environmental, social, and governance risks on our credit ratings. And by far, the most influential of those ESG elements is governance when it comes to our financial institutions' ratings. We've seen a number of rating actions over the past few years that have been driven by what we would call conduct issues, whether we talk about challenges at Wells Fargo, U.S. Bank, Swedbank, Danske. In Australia, we have National Australia Bank, Commonwealth, all of which have had challenges in a broad category of conduct, and that has had an influence on our ratings. The big question that we're trying to figure out, or one of the big questions, is can conduct be regulated or governed or disciplined in a better or different way than it is currently being managed? I would think that would take some global coordination. And curious as to whether you, Dick, and Mike have an opinion on conduct risk and better ways to manage it or vet it or make the entities more transparent in that regard?
Yeah, no, it's a great question because, this past semester I taught a course in risk management and financial stability, and I introduced for this semester a whole section on conduct and culture risk because I think it's really important. In the past, what we've relied on is sort of being the cops on the beat and ex post. We punish people, we fine them, we uncover wrongdoing of whatever shape or form it takes, and we penalize people. The problem with that is that often some of the firms, some of the bad actors have just viewed this as a cost of doing business. And so it really doesn't accomplish what people want to do, which is to change the culture, change conduct. And I think there are a couple of things that can be put in place. One is for not necessarily to regulate, but to articulate principles. And there's been some good work on that done by the G30, by the New York Fed, by others. And in the UK, with a focus on markets, fair and effective markets, and also in the foreign exchange markets, the FX Code of Conduct, I think, are good examples of the way that people are articulating principles that people need to follow in doing business. In addition, in the Treasury market, the Treasury Market Practices Group has articulated a set of best principles, and that's what they're really focused on because it's in everybody's interest to make these markets function well. In financial services, trust is essential as bedrock ingredient for making finance work for everybody. And if people don't trust a firm or they don't trust a market, then it's not going to function well and it's not going to serve our purposes. So it's really essential to get this right. And those codes of conduct or principles, I think, are important. But I think the second thing that's important, Kevin, is to put in place incentives to make people do the right thing as opposed to the wrong thing. And some of that relates to compensation. Mike mentioned the compensation 956 in DoddFrank, which is worth taking a look at. This goes beyond DoddFrank as far as I'm concerned. Compensation principles and the way that we compensate people ought to be aligned with achieving trust in an institution or trust in the system as a whole. And if it's not, then we ought to really be taking a hard look at it. And so that's just one example of where I think we can do things to regulate. Now, the role for government in this, to me, is where instead of somebody getting up and saying, the music's still playing and we have to dance to that music, I think government needs to step in and say, look, this is what works for us as a society. This is what works for the system, and you're going to have to do some of this. But it's ultimately going to be up to the firms and their managers and their boards of directors to really put in place the kind of culture that is essential for good business. And hopefully what happens is those are the firms that really thrive and survive. And the ones who don't are the ones who effectively go out of business.
Okay. Thanks, Dick. I see, Mike,
Yeah.
you're nodding your head, and I know you have some opinions.
Yeah, no, on that, right? So there is, there's the regulation, the principles, but it's ultimately up to the management and the board of directors. Right. And just frankly, I think the banks are missing a huge opportunity right now to go beyond sort of minimum standards, minimum principles. If you look at what's going on with, the House of Financial Services, with the CEOs going up there, it's clear that there's a number of members of Congress that want to shed light on, particular practices that they don't think that the banks should be doing, right? And we're going to continue to see that, right? You're going to continue to see sunlight put on those, right? And if the polls and surveys of Americans and stuff are still really mad at the banks after the financial crisis, right? The banks got bailouts, homeowners didn't get bailouts, and it's across the political spectrum, far left, far right, doesn't matter. There's still that visceral reaction for folks. People were mad that people didn't go to jail. Forget about whether people should have gone to jail or not, but there's still that sort of visceral reaction from folks. So banks, forget about sort of the minimum standards on this stuff. They need to go above and beyond and take this opportunity to see how, and show people, Dick mentioned, how to make the financial system work for everyone. And if you look at, particularly among young people, the surveys and stuff, right? The S word, socialism and stuff, but even just the young people's view of the financial system, is it working for them? And it's not in a number of ways. Right? What do they grown up, what have they known, right? So those that are coming in their 20s right now, they know about the financial crisis. They see, the student debt. They're incurring student debt. They saw what happened with people who bought houses. They don't want to buy houses and all that sort of stuff. The financial system's not working. The banks need to go out there and start thinking about whether it's products, services, whatever it is, to make it work for them. And they need to get out there and be more proactive about marketing and communicating that.
I agree, and I think the key words you both mentioned were trust and confidence, right? That's people have lost it, and it's not necessarily regulation's job to rebuild trust. Regulation has another responsibility, although it does ultimately help with trust in the system, but trust and confidence are often self-created. Okay, so I want to transition now to something we've been talking about throughout the day, which is this idea we're late in the cycle, risks are potentially building, new risks are emerging, and I'm going to ask our audience a question. Question is, what is the biggest risk facing financial institutions? Is it conduct risk, cybersecurity, regulation, an economic downturn, leverage loans or excessive leverage, or none of the above? Don't trust the first answer. I'll read it off in a second. Okay, right now it is, all right. It's evolving very rapidly. Okay, so I'll call this about the end. So economic downturn has the biggest portion. Cybersecurity is second. Dick, you were right about regulation. He's like, regulation isn't a risk.
No, there are risks in regulation.
Yeah. And I guess we gave everybody so much confidence that conduct risk is going to be resolved that we don't have to worry about it. And then there's some asset concerns about leverage loans. So, Mike, let me start with you. Where in the financial system maybe do you think risk is building that you are particularly concerned about, or if you don't think that is the worry, what is or are your key worries in your seat?
No, when I was in the regulatory world, I was often asked what keeps you up awake at night, and cybersecurity was always the one that I worried about. And there's just a number. We had a cybersecurity roundtable at the SEC, and I asked the question of well, who should I think of in terms of hacking, a financial institution? Should I think of a state actor or a mafia? Is it, somebody sitting in their basement or whatever it was? And the answer was all the above. Right? And just the statistics that we get from financial institutions that we were learning from, the number of attempts that they get on a daily basis, it is mind-blowing. And it's kind of like, if you think about guarding against cybersecurity risk, right? It's kind of like being a cornerback in football versus being a wide receiver, right? The wide receiver only has to be right once. The cornerback has to be right every time to be successful, right? To defending in this thing. I was actually, I'm getting more confident in our ability to defend this stuff. I had the opportunity to visit some students at a university, a cybersecurity club, and what was interesting was that there's these hackathons and competitions that they go to, and there's government folks that go there and see these things, and so they're gaming it and stuff. And I asked the faculty advisor of the club, I said, "Oh, this is great. So how many classes do you teach in this?" He said, "We can't teach a class." And I said, "Why not?" He said, "By the time we get the syllabus done, it's different. It's almost like a gaming sort of thing where you have to constantly be working at this." But I worry about it not just from stealing people's money and that sort of thing, but also using it as a way to potentially destabilize or spread false information and causing a bank run. I'm not so worried about the biggest banks, right? Because they're the ones that have the best systems that are available, right? Why do people rob banks? Because that's where the money is, right? Why do people hack big financial institutions, right? But if financial institutions generally, right? We have really small investment advisors and broker dealers and mutual fund and that whole landscape, and we were always trying to make sure that everybody was up to speed. And there's always that adage. There are two types of firms out there, ones that have been hacked and ones that don't know they've been hacked. And how true that was, I didn't know this at the time when our new chairman came in at the SEC. He did a review of all of our cybersecurity systems and found out the SEC's Edgar system had been hacked. It was the test system for filings, and it was actually contained. But here I was going around, sort of telling that story, and the SEC itself got. So I worry about the government systems getting hacked, and we're collecting a lot of this data, and it's one-stop shopping, and what people can do with that data. So that's the one that I worry about the most. And then something to either destabilize the system or shut people out. We're becoming so reliant on this digital world that something could bad happen there. So that's the one that I worry about the most.
Yeah, I generally agree with Mike. I think that he said it well, that this is something that's pervasive, that's hard to measure, it's hard to get our arms around, and in addition, people are reluctant to share information about it because there's a stigma attached to being hacked. And so we have to get to the point where people see there's greater benefit from sharing the information in the appropriate way, so that people can understand and learn from what's going on rather than just hiding it and saying, "Oh, nothing to see here," because there's a lot to see here. But I think there are a couple of other things that we want to mention. Climate change is something that people have thought of as something that is down the road. It's an emerging risk. Maybe our grandchildren don't have to worry about it. I think this is here right now, and it's facing financial institutions, obviously insurance companies, but almost any financial institution is going to have to deal with that in one way, shape, or form. Geopolitical risk is clearly out there. Those two aren't on your list, but I just want to mention them because I think they're things, non-financial risk, besides conduct and culture, that are worth mentioning. The other thing I would say about this is that when you think about how these things interact with each other, it's important in thinking about how to analyze them to think about the interplay among them, and they all in some way, shape, or form are interconnected, and they all feed back into financial risk. So we need to think carefully about how to measure, how, if we can, how to think about what policies, if there are any that are appropriate to take to mitigate those risks. We need to think about how to make the system and institutions more resilient in facing those risks. Those are things that are out there that we need to work on more.
And one of the things you had both mentioned in some of our discussions was the risk of central clearing parties, and are we collecting? Is the transparency solution, creating some new collection of, of risk.
Sure, this is a great example of where there are benefits to central clearing of derivatives, of repo transactions, of other things for the system and for institutions. But we also concentrate risk in these CCPs, and so if you're going to put all your eggs in one basket, you better watch that basket very carefully, and you better have that basket as resilient and strong as possible. So there's been some work done, obviously, on that, thinking through, what resources the CCPs need, whether it's, resources in the event of a default, whether it's resources that look like capital, whether it's resources that provide liquidity so they can meet their timely obligations in the event of an accident or a default. The operational or cyber implications of CCPs, really important. If a large CCP goes down because of some operational issue, that's going to be problematic for the entire financial system. And so there have been some stress test work that's been done and other things. The good news is that I think the regulators are really focused on this. The CCPs are as well, but there's more work that needs to be done to make these resilient institutions.
Yeah, absolutely agree. I mean, that was during the debate of DoddFrank of what was going to happen to help try to mitigate some of the risks. And there were some folks that said, well, let's just put it all into CCPs, right? That'll just make everything better. But as Dick points out, there's costs and benefits of putting stuff in the clearinghouses, right? And when I forget who came up with this frame, but this is the way I sort of think of it, is there's two risks when an institution brings something to the clearinghouse. There's the risk of whatever that contract that they're bringing is, and then there's the risk of the balance sheet of that financial institution bringing it to the clearinghouse. And the clearinghouse needs to make sure that they understand both of those risks and are mitigating those. The other thing I worry about is that clearinghouses, if you start putting some of the more esoteric stuff in there, clearinghouses don't have any specific knowledge about specific types of markets, right? As opposed to trading desks on banks that are very, very focused on whatever they're trading, some precious metal or something like that. And they have a lot of information about what are the key mines or what are the key choke points in the supply chain and that sort of thing. Whereas clearinghouses tend to look at data and, well, historical data shows there's no volatility, so we don't have to worry about that. And so the margin requirements are low or whatever it is. And then all of a sudden you have a big jump in a price, and so they're caught. And I worry that at a clearinghouse, some sort of liquidity problem is going to turn into a potential spreading in terms of an insolvency problem. In effect, Dodd-Frank created another too big to fail institution. Now, recognizing that, they've allowed the Fed to provide liquidity in an emergency, and there's some debate on how they're going to do it. But my view is the Fed will figure it out and actually do it. The other thing is, the clearinghouses are under the jurisdiction of the SEC and the CFTC, depending upon whether it's a swap, a security-based swap. One of the things I was heartened to see was that in Dodd-Frank, it was actually an amendment that was added that gave the Fed backup authority in this, right? So the SEC and CFTC traditionally are market regulators, are not prudential regulators, and don't necessarily have the expertise on regulating something like this. That it's a non-bank, but it needs to be prudentially regulated. And so I was heartened to see that the Fed, who does have that expertise, were sort of the backup regulators, and their people are taking this very seriously.
This is part of a broader question, Kevin, because CCPs are an element, a key element, in the whole system of payments, clearing, and settlement. And that plumbing of the financial system, which most people don't think about every day, is critical for its functioning. And any part of it that breaks down is going to disrupt the functioning of the financial system and financial transactions. And so all those things are critically important, and steps are being taken on a global basis to reduce risk, for example, by embracing faster schemes for payment. And you can reduce the risk of T+1, T+2, whatever the settlement is, the financial risks, by speeding up the transactions. Now, speed also brings with it its own risks. And so we need to think carefully about exactly how we're doing that. And the Fed, for example, is looking at real-time gross settlement system and how they would implement that. The Fed's been lagging behind other jurisdictions, but in thinking about that, they're thinking about where the risks, what new risks are we creating, what problems are we solving, and all that is part of a network that needs carefully to be thought about.
Yeah, could I just add on? So when we were at the SEC, the settlement system for securities was we were at T+3, which we were behind the rest of the world was at T+2. So one of the things that Commissioner Stein and I did when I was acting chair, we were down to 2 of us, was we actually moved to T+2 to catch up with the rest of the world. And people said, well, why don't you guys go to T0 or T1? We could actually do that. The reason why we couldn't do that is because the banking system, the payment system, was still at T+2. And the reason why that's important is because if somebody writes a check to their broker, we didn't want to have the securities transaction clear before actually then the thing comes back non-sufficient funds and you end up with a problem there. So what we decided to do was move to T+2, and now that puts hope, and what I was hoping, and it is starting to do this, is put pressure on the Fed and the banking regulators on the payment side to start speeding that up to get the rest of the world. And I don't know what the exact numbers are, but there were big numbers that we calculated that we took systemic risk or counterparty risk out of the system just going from 3 to 2. If we can go from 2 to 1 or to 0, it would take even more out of the system. But now it's on the banking regulators on that.
Terrific insight. I'm going to take advantage of the fact that we have you guys trapped on the stage and in the spotlight to go a couple minutes over our time because I want to touch on GSE reform. Both of you have, I'm not going to say inside information, but insight that
No inside information.
Yeah.
Insight.
Not now, anyway.
Insight.
No material, non-public information in the breach of a fiduciary duty. That's the hard.
Insight that that many people don't have, and buzz has been building quite a bit recently about GSE reform, new FHFA head, and the potential for executive order type of change versus congressional. So, Mike, let me just start with you. How do you feel about momentum for GSE reform? Do you see something real happening over the, call it the near to midterm rather than someday?
Yeah. So in the introduction, Kevin mentioned I'm at the Milken Institute, and when I came in, one of the pillars that's under my center is housing finance reform, and so we have a really good set of housing fellows. And I said, what are you guys working on? And so we were kind of going through the different things that they could work on, and we were talking about the prospects of legislative reform, either in the new Congress coming forward, and we all came to the conclusion Congress hasn't acted, they're probably not going to act, but the administration could do things incrementally in the various agencies, whether it's FHFA or HUD or FHA or CFPB, to incrementally make the housing finance system better. And so we decided for them to work on a paper that lays out what are administrative reforms that could get done, and we released that in January, and it was 14 different sort of recommendations that they could do. And then we went up to the Hill after the changeover in Congress, and our priors going up to the Hill, at least my priors were that, all right, we're going to talk to various members of Congress and their staff, and they're going to say, yeah, we're interested in getting legislation done. And our thoughts were, all right, they're probably not going to get anything done anyway. To my surprise, we went up there. There was zero interest in even pretending to get any legislation done. It was amazing to me. Right?
You had a low bar to start with.
Yeah, the low bar, right? So it just looked like there was fatigue in this, right? It's been tried so many times to get legislation done, right? So, all right, well, that's interesting. I'm glad we wrote this paper because now it's the administration can try to get this done. What's interesting is a couple things have happened. One was administration officials talked about, a plan for the GSEs, and then Congress was, wait a minute, we want to be involved in that plan because it's the charter is statutory and maybe they need to fix it. So we saw a little bit of movement. The biggest thing that's happened now all of a sudden in Congress is, wait a minute, we want to get involved now, is Mark Calabria coming in as the director of FHFA. It's clear, I've known Mark for years, he's someone who helped write the legislation that created the FHFA, that created the conservatorship. He knows exactly what he's doing, and he's moving forward. And Congress now is like, well, wait a minute, we want to be part of this. So you're going to see Congress reacting to things that he's doing, that he has the authority to do under the statute that created that. And he actually was there when they wrote that, so he knows exactly where that authority goes. The second thing you see is the administration. The president put out an executive order directing the Secretary of HUD and the Secretary of Treasury to develop a plan for what things they can do in terms of the agencies under their jurisdiction and some of the other ones in terms of what can the administration do administratively without Congress actually moving, and that to do back, I forget when that is, and they're reporting back to the National Economic Council and then the administration. So the administration's moving forward. And you're going to see the agencies do whatever the things under their jurisdiction, whether it's patches for various things or whether it's down payment requirements or those sorts of things, affordable housing goals, whatever they already have the authority to do, the administration said they're going forward. Whether or not Congress gets its act together and does anything like fix the charter for the GSEs or do anything else, I think they're going to protect. I'm not optimistic on that. I think the chances are less than 10% to actually get anything done, but we'll see what happens. But the administration is moving forward.
Yeah, I don't have a lot to add to that. Having not only read but participated in the discussion around the reports that Mike and his team have done, and some of the people who wrote those reports used to be my colleagues at Treasury, and I think, as Mike said, there are at least a dozen good proposals out there on the table to fix things. The question is getting the will to actually implement them. So we'll see what happens. I think nobody wants to, and nobody will bless the idea that for the GSEs we're going to do recap and release. That makes no sense whatsoever. Yeah. And that whole issue, I think, and its real consequential import for the whole housing finance system is something that probably stands in the way of getting a lot of things done. But there are some things that have to be done. One of the things that's really important is if we have insurance fees, G fees, guarantee fees, how we set those is going to be critically important for the way that the system functions. And there's two schools of thought. One is you got to set them in a way that makes sense and that doesn't encourage excessive risk taking. The other is, well, we need to have some subsidization of this process so that the system will work better. I'm in the former camp, but there's a lot of debate around exactly those things, and where we come out, whether it's in the middle or somewhere on either side, remains to be seen.
Gentlemen, thank you very much.